We are entering into another session, and in this session we are discussing about something we have already said about. We said when we started the chapter, we said about there are requirements, financial requirements in a firm, and it can be for long term and short term. And when we are considering long term requirement, usually those type of requirements require money to be invested into assets which can bear its return, return only after a longer time. Or to say it in simple words, we need to make investment in long-term assets, or we call it fixed assets. So that investment, that portion of capital invested in fixed assets is termed as fixed capital, and we are going to learn about that in this session. Fixed capital. What is fixed capital? Amount of capital invested in fixed assets. The amount of capital invested in fixed assets is termed as fixed capital, and it is affecting that amount which we are investing into fixed assets affect the growth. That means the fixed assets which we are using, it can be machinery, it can be land, it can be any modernization or anything happening. So such kind of fixed asset, long term requirement affects the growth, profitability, and of course the risk of business, because it has so many aspects which we have to consider. Growth, because it will not bear immediate return. So for further purposes we must have enough money. The same way profitability, it will be bearing the return, it will give us some benefit only after a longer period. Same way risk is there, because we may have to handle the financial requirements. Apart from these investment which is made in fixed assets, there are requirements in business for short term also that must be handled. We must have enough money and all. So we have to keep in mind that it is affecting the growth, profitability and risk of business. That's a very important thing we have to consider when we are going for investing into fixed assets. It can seriously affect business because it have bearing on long term growth, because the investment which is made in fixed assets will fetch return only after a longer period. In long run, growth in a long term basis only happens when we are making investment in fixed assets, and large amounts of funds are required. When we are looking at fixed capital, large amount of funds we need to invest. And again, risk factor is involved. As I have said, risk factor is involved, because till the time of some return from the investment made, we will have to handle things which are happening in between that. For that, we need to have return, we need to have other sources. So there is a chance of risk. After a longer time, it can or it may not fetch return as expected. So there is a risk factor, and of course it is irreversible decision. Once we have made investment in a fixed asset, fixed capital investment is made, it cannot be reversed very fast. Even if we want to reverse, we may have to spend some money. Cost is associated. We may have to spend cost. Extra cost is to be spent. So because of these four reasons, it is to be taken. It is to be considered very important when we are going for fixed capital decisions, or what we have learned in the beginning, capital budgeting decisions. Same. We have to keep in mind all these things. It will fetch us return only after a longer time. Large amount of funds are involved, risk is involved, and it's a reversible decision. So when we are planning to go for fixed capital, when we are going to invest into fixed assets, we have to take great care. And one more thing you have to keep in mind is that fixed capital must always be raised through long term sources. The amount of money invested into fixed assets must be raised from long-term sources like equity shares or debentures or such kind of long-term loans, or retained earnings must be considered, because all these things give us time to handle situation. If we are going for short-term source, it has to be repaid back. We may not get a return from the investment made immediately. So, it is always good that when we are going for fixed capital, it is raised through long-term sources. It is raised through long-term sources. So, amount of money which we are investing into fixed assets or for long-term purposes, we call it fixed capital. Now, there are certain factors we have to keep in mind when we are going for fixed capital. Factors affecting requirement of fixed capital. How fixed capital requirement is there in the firm in different situations. First one is regarding nature of business. Nature of business, up to a level decide what is the level of fixed capital required. If it is a production firm, we need to have machinery, we need to have land, we need to have we need to have machinery. All these things requires more amount of fixed capital to be invested. But if it is a trading firm, we are getting it from someone who has produced and we are selling it, we may not need that much of fixed capital. So, the nature of business, what kind of business we are doing, up to a level decides what is the level of fixed capital required. So, nature of business is one factor which decides the requirement of fixed capital. Second one is the scale of operation. Scale of operation means in which level we are doing, whether we are doing it in a large scale, whether we are doing it in a small scale. Large scale business requires more of investment into fixed capital, whereas when it is in small scale, we need less of machinery, we need less of space, we need less of investment, because the scale of operation is comparatively less. As scale of operation is less, automatically the requirement of fixed capital also comes down. Choice of technique. Choice of technique means there are two types of techniques which is usually adopted. One can be labor intensive and another one is capital intensive. Capital intensive techniques are those techniques where less of people are required and more of technology, more of plant and machinery. Manual labor is comparatively less, whereas machine requirement is more. If it is capital intensive, the manual labor is comparatively less, more of machines and technologies, more of machines is being used, plant and machines is being used. In such situations, we have to spend more of fixed capital. But when we are coming on to labor intensive techniques, more labors are there and less of machineries are there. So, there the requirement for investment into fixed asset like a machinery and all is comparatively less. So, capital intensive techniques requires more fixed capital, whereas labor intensive techniques require less of fixed capital. So, which choice we are adopting decides what is the level of fixed capital we have to maintain. Technology upgradation. If we are using different technology, machines or whatever be, if we are using machines, if we are using technology which have a chance to go older, go obsolete, we may have to replace them, we may have to upgrade them. There it requires more amount to be invested. But if we are having an upgraded version of machines, modern machines where no modernization is required, no upgradation is required, automatically fixed capital need to be spent only for that machine, not for any upgradation. But if we are having an obsolete technique, obsolete machine, we may have to either purchase a new machine or we may have to spend money for upgradation of the existing technology. So automatically that adds on to the course, adds on to the cost. So technology upgradation also decides whether we need more fixed capital when we are having obsolete technology, or whether we need less fixed capital when we have the modern technology. That also decides the level of fixed capital required. Then coming on to growth prospectus. Growth prospectus, automatically when there is a high demand, higher growth of organization, or when there is people positively responding to the organization, there is a growth in organization, we may have to cater to the needs, cater to the demand of the product which we are having, or which we are selling, or we are marketing. There we need to make sure that production, or the orders are handled in a better way, where we are having where we are handling the orders, handling the demand in a most effective way. There we may have to maintain more machines, more land, storage facilities, all these things are to be made. So in such situation, when there is a growth, for business, it automatically requires more of fixed capital. When the growth is less of fixed capital is required. Diversification means entering into new area. For example, in your text it is said that a company which is running a textile business need machines for those purpose. But if that company is planning to start a cement division, cement section, machines are not the same. They must purchase new machine, new building, new go down, all these things are required. So automatically when diversification, when entering into new area of business, fixed capital requirement is required more, whereas if there is no diversification, fixed capital required will be comparatively lesser. Financing alternative is another factor which decides requirement of fixed capital. Financing alternative means if we have to purchase a machine, we have to purchase a land, we have to purchase a machinery, or it requires a large amount to be spent for that. But if there are some alternative like leasing, where we need not to purchase the machine, we need to pay the lease rental. So that huge amount requirement can be brought down with the help of such financial alternatives. So if such a financial alternatives are being used, the requirement of the fixed capital can become lesser. So that is also another factor. Which decides whether the financial alternatives available. There are different financial alternatives available. That also decides what is the level of fixed capital, requirement of fixed capital. Last one is level of collaboration. Level of collaboration means when, as we have said, in some fixed capital, if two companies doing the same business is agreeing to use the assets in common. For example, an ATM machine, if it is permitted to be used by two banks, one of the bank can save money, save capital from investing for a new ATM machine. They are reaching at an adjustment agreement between the other bank. The collaboration level helps to bring down the cost which is spent for purchase or installation of a fixed asset. So that is also another factor which decides the requirement of fixed capital. So we are talking about fixed capital and the factors affecting requirement of fixed capital.